Hello, Warriors. What do you guys want for Christmas besides Pips? With Pips, you can get everything, but you can't buy love. Hey, guys, you ever think about this? What good is happiness? It can't buy you money. Ever think about that? All right, so I'm thinking about the crude doing another false breakout. I think that 2019 was the year of false breakouts. I've, seen a few years in the market, and it's almost like now I don't expect breakouts to work. The one clean one that was really simple, and I didn't do it, was the gold breakout. You know, I mean, it never looked back once we got over 1360, right? I mean, this was one of the cleanest breakouts. And you know what? Let's look at this. You know why it's such a great breakout? Because if you didn't buy this candle or long prior to the candle, you were waiting for a break to buy, you missed a huge move. I know Blake was bullish during this run. I know Stell was. I know there was some pattern in place for this move, but you know what? This is how they should be. When you start seeing breakouts, say, come back and test it, then hold it, and then test it and hold it. This is how a breakout should act. If you don't act on the breakout, you're going to have to end up, paying up. That's all there is to it. Those are the good breakouts. So perhaps this crude will turn out to be one. I mean, that's a big channel line. I want to see Steve's, but it's trying. And we had a pretty negative bar last night. Well, the 1 hour candle, but we still have this. So I'm hoping that my theory of that markets rarely peak when the high is confirmed turns out to be wrong this time. Okay. So we're going to need it back under 60 bucks. See what happens here. 61.50, a little bit above that, I'm out. Maybe we have one more drive. Are the S&Ps going to put on another drive? We've been sideways for a few days. And to me, it's just sideways. Is it distribution, or do we have to take another stab at 3,200? This would say that we're going to take another stab up there. Okay, so this is also, I believe, a triple witch, quadruple witch week, and normally the best days for people to do their, wrap it up and distribute or accumulate whatever is usually by midweek of a major expiration. So here we are. Um, I think a lot of people might be kind of befuddled on the euro and the dollar. This rejection. I know that Greg had a 112 target. I talked 112. I don't remember why. At the beginning of the week, I showed this, though. This 50-day contained it. It's an inside week. As I look at this, I think I would just wait for action over 112 and go for it. You're tempted to, want to buy the break, and, maybe it's going to be deep. We're still not going, you know, we're still not going to have a 2 week reversal here, but even the good weeks, you notice this, even a good week really, gave up a lot of its gains. So, it's iffy to me. If that's the case and the dollar has more in it, and here's my prediction on what I think is going to happen in the yen. See how we haven't made a new high yet? And this is a hope high and another hope high. And a lot of people are going to call this 109.70 a breakout when we get through it. maybe it happens today. Um, I would watch this thing, let it do what it wants to do above the breakout, but be prepared back under 970 to go for it. Or if you have some kind of divergences, some non-confirmations up here, because I think there's a possibility this will just end up being a false breakout. A lot of people are going to say it's a major breakout, and it probably measures, 111 at least. So watch this, because when you look at the longer term chart, the daily, I mean, it's just chop, chop. Maybe it's with this one more push up in the dollar, we get a breakout here. But what is weak is US dollar Swiss compared to the yen. So if we get some dollar strength, maybe we get back to 99, that would be a sell to me. 98.80, 99.10. And something I noticed with strong crude and a weak dollar is that Canada's starting to shape up. Okay, so this is going to be a major breakout over 33. And early in the week, we diverged down here. Maybe it'll probe it again. But, when you think about it, Canada, during a period of a weak dollar and during a period of very strong oil prices, you know, why haven't we broken down? So watch this week. And, right here is where you probably try and get an edge and you're wrong under, 100 pips or so. But this will be a nice breakout above 133. If that happens, I think new highs are coming. So that's it. I'm completely out of thoughts. So who's been naughty and nice? Anyone out there at the same time? Steve Olgie, you're naughty and nice. We know you, man. Blake, you have your earmuffs on or your headset?
A little bit of both.
Remember earmuffs?
Yeah, yeah. Actually, it seems like at every adult event I'm at with kids, I'm like earmuffs, kids, because
uh,
yeah,
yeah, like,
the adults
yeah.
get a little rowdy at this point.
Okay,
How you doing?
good, man.
You asked what I want for Christmas.
You want volatility.
I want volatility, baby.
All
And
right.
just
All
some
right.
volatility would be great. Yeah, that would be
I'm
awesome.
gonna start praying for some
You
volatility.
got to, this
Yeah.
is the I tweeted it out earlier. This is the
You showed it yesterday, this thing, right?
well, yeah, this is the dollar yen, not
Oh, God,
not the
another
euro.
one.
This is the dollar yen historic uh all-time low volatility. I mean, it's crazy, right?
Yeah, all of them are.
Yeah, I mean, this is the all-time low in volatility for the dollar yen. So, that's crazy. Let's see. Let's see if I can let's go euro US dollar.
Do you think this is what the central planners wanted? Just like to have things pegged and quiet, and they're probably not crazy about speculators.
Oh no, no, of course
They
not.
would want to, like, kill the game.
Yeah, it's basically what it is. There's the euro dollar,
Yeah.
implied volatility is at record lows. I mean, these are just, this is and expect it to be worse going into the end of the year. I mean,
Oh, yeah.
if you're expecting, this huge volatility in the year end, I wouldn't expect it. Whatever you see right now is you're going to see this grinding move. Might be a little bit of dollar recovery. It looks like we're getting some gold weakness. Here's gold. Let me pull it up over here. This morning we got gold. I mean, gold's just trapped, in this
Yeah.
triangle. I mean, I would think gold, grinds down another 10 points from here. It's not a lot, but
There aren't a lot of gold bulls right now. DSI's in the 40s,
yeah,
30s.
it's very, very, very low. I mean, there's and the biggest mover right now is the cable. And I'll tell you what, I got a bid out in the cable right now.
Makes
I've got a
sense.
bid. Where would you guys imagine that I have a bid?
130.
130, yeah. Just above 130. I'm looking at 130 and a quarter, but there's going to be
You owe me a Coke
one.
because I
I owe
gas
you a Coke.
started.
Um,
Jinx.
Jinx Coke, owe me a smoke. Is that what it is?
Yeah, that
Yeah.
too. With
Or
my
so
Coke.
we,
All right.
or we would say Jinx Poke, you owe me a smoke. That was in
Oh,
the yeah, but that was old school.
oh
People
wow.
don't smoke anymore, but
Yeah.
But anyway, the cables, it's given back all these gains, and it's crazy because everybody was so bullish the cable. I wouldn't say maybe it's crazy, but you know, it's people were bullish, and here we go. We've gone from 135 below 131. We're probably going to trade down to one. I would imagine if we spike through here, let's go to the hourly. So this is 130, what, 50? 130, 50. I would venture to guess that we do this. Boom, 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 like that. Right. So if you guys are looking to pick up some cheap cables, cheap cables, cheap cable, I think the 130.25 level is probably going to be a place where you see some buyers, and that's just it is what it is. That's probably what we're going to see. You're going to see these sellers come in, and I got to prepare for this too. Let me see here. I'm just going to make sure I have some orders ready in the event we get down there, because let's see if we could do it like right now, maybe while I'm on. There's this 15 level. Let's see what happens here. You know, see if we get some action on the face webinar. Whenever I used to do the morning edge, I'd be looking for some some price action, and see if we can get some, and we might actually get it here. So let's see if we can get some selling. It'd be nice just to get some activity. But one thing that I want to reiterate, and let's just let's go back to kind of something that I was saying over the last couple of days. You have to really pick your um you have to pick your places that you want in, not not chasing the market. If you're out there shorting the cable right now, which is fine if you're shorting it, but you better know where your risk is. And instead, what I look for is I look for places that might be of value, and we might actually find support ahead of this 130.50 level, but I'm hoping that we get a push below it, quick trip of some stops, and an opportunity to be a buyer. A couple other things that I guess we can mention while we're waiting for the cable to see if it's going to move here or not is this euro. Really epic fail at the 200-day moving average once again. We couldn't close above it yesterday, as we noted in the analysis last night. The euro dollar once again closed below the 200-day moving average. Any rally close to the 112 level gets hit. However, the price has been grinding higher overall, so stops above the 120, 112 level may be building, which I do believe. I do believe that, if we get above 112, there's going to be, hell to pay for shorts. But, right now, in my opinion, we could drop all the way down. Remember, this is a massive trend line. Let's just, take note of it. This one right here, this dotted one, that takes us all the way down to, let's say, roughly below 111, so 110.80 ish. So if you imagine the cable dropping to 130, well, I think the euro could very easily drop to 110.80, and then at that point in time, that might be the level to be a little bit of a buyer, just to buy on dips rather than being a buyer above the 200-day moving average. You want to be a buyer as it dips down towards, and you can see this is a lot of congestion over here. I got some comments coming in, so let me grab those here in a second. But you can see this congestion area. That's the level that I'd be a buyer. Down here why buy it up here when you know it gets stuffed every time it comes up here? So let's be a buyer down on dips if you guys are really bullish. Okay. So anyway, just some food for thought. And also keep in mind that we do have like the Norges Central Bank tomorrow. We have the Riksbank tomorrow. So the US dollar, Norwegian krona, US dollar, Swedish krona, those might be decent traders tomorrow morning. And I have to say, like, if you are bearish the dollar, probably trading these pairs, like, probably like short US dollar, Swedish krona up into that zone, or maybe US dollar, Norwegian krona as well, shorting the US dollar, Norwegian krona into this zone. That might be the, better trade, just waiting for a central bank to be a little bit more, hawkish or if you will, if that's the way you're trying to position yourself. But I think the dollar, trading some of these Scandinavian currencies, some of these Scandies might be the way to go. So let me see if I can address a couple comments as they come in, just in the chat box. By the way, guys, if you're looking to, let's see, Shahab asks, what do you think about the Euro NOK? I haven't looked at it actually in probably a couple weeks. Let's take a quick.
I'm short that, Blake. I've already said it on the webinar.
Steve, no one asked you. No one asked you.
Really?
I mean, I'm the guy talking. I'm the guy talking. I'm just kidding.
I know you are. I'm living.
No, but
see you I'm short because if you see the last rebound was clearly corrective, so I actually shorted the breakdown of that flag. Yeah, that one.
I think actually the Euro Norwegian krona is a good short. I like the Norwegian krona long, just in general. So I actually think the US dollar or the Norwegian krona is going to strengthen. So I think if you let me just grab something really quick. If you think about like tomorrow, and with the Norges Central Bank there, we're at the 38% retracement. So a clear break of, like, let's just call it 10.01. Man, that would be that'd be quite bearish for the pair.
I think it's going to take us to the 61 point. Yeah, there at that confluence.
I think that's a trade. If where your risk is above 10.10. So if you're short, if you think about a risk reward trade, and that's what I'm always thinking is, all right, well, what's the risk versus reward? Let me just do this really quick. So your risk is here, right? Your reward's here, roughly. So if your trade is here, let's just call it right there, you're risking 1 to make 2.5. Yeah, that's doable. I mean, that's a doable risk reward if you want to take a trade ahead of the central bank. If you're like, okay, well, I'm going to see if I can get a little bit better price on it. Like if the euro, excuse me, can bounce a little bit, or maybe the Norwegian krona can weaken a little bit. Like up here. Sorry, guys, I mean to yawn. I feel like I'm on the cusp of a cold. This morning, I woke up this morning and I'm like, oh man, and I'm trying to avoid it ahead of Christmas. So I'm taking I took 300 milligrams of vitamin C, and I'll probably take another 200-300 this morning or in this afternoon. So if I sound a little, nasally and coughing, that's the reason why. Anyway,
excuse me.
There you go. We have another one.
Right.
Steve, I'm so glad you're back. I heard you ran away with the circus.
Oh, I did. Yes, I did.
Oh, but you came back to trading after one day at being with the circus?
Some of the girls there that were performing tricks, you would consider going away with them, I bet.
Tricks.
All these acrobats and
I know what you mean. But I know what
you mean the bearded lady, huh?
Yeah,
Yeah,
I tell you, that's a fantasy of mine still.
yeah.
So,
Back in the day, that was an
uh,
actual joke, but today, unfortunately, it's much closer to reality than you would like to admit.
yeah.
So Forex Gal said, "Hey, what would take? What's gonna make some volatility?" My opinion is central banks starting to get more, um, you know, more dovish or hawkish. Based, I mean, I don't know how you can get more dovish, but maybe getting more hawkish, and we start to see some moves in rates.
There you go. That's
That's
what I think you need. That's what you need.
that's going to be the volatility creator, I think, when you start to see a divergence between expectations between central banks. And I think we're on the cusp of higher rates. So um you
Yeah, the
know
10-year doesn't look bad, Blake.
huh
10-year looks like it's on its way to 210. Gunlech had that target in the 10-year note.
Yeah, I was watching a 50-minute interview of I'm only about 20 minutes into it because I started watching it before this webinar from it was Stanley Druckenmiller on on Bloomberg. I think it was a Bloomberg exclusive. I was watching it from my terminal, so but
Yeah.
he's actually long some Aussie yen. He's long some Canadian yen. And
Risk on.
and he's expecting he's expecting higher rates, and he thinks that he's long a little bit of equities. He doesn't manage a fund anymore, but he's obviously George Soros's old right hand man, and very popular in the last 10, 15 years as a fund manager anyway. But just to answer your questions, I think rates and moving rates would do it. So I mean, if you're taking a look at the 10-year, yeah, I mean, we get below the 200-day moving average in the 10-year here, and you start to see yields move up. And by the way, this is not relevant anymore. Let me just get rid of that really quick. I think that's going to create some volatility. So
Yeah, it looks
anyway,
like a descending triangle almost.
FX call says I buy pound here. Where you stopped out in the euro pound? No, I actually got out of the euro pound at 84.70 yesterday, about an hour after we were on the webinar. I got out at what was it, guys? 84.77, I think it was. So I shorted it up here yesterday, and I closed it like right here, somewhere around here, and I made like 22, 23 pips. And I'm like, nah, I'm done with it. But no, I'm not trading the euro pound right now. See, if you were in the Forex Analytics chat room, which is the Forex Analytics private community, you just go right over here to the chat room.
He would
These
know
guys.
that.
Yeah, I mean, you would have known I was out yesterday. I got out, at a decent hour. There's a chat room with us, and for a slow day, we still got 66 people in here, and it's slow. I mean, it's like molasses slow in the market. Oh, sorry, Benedict. Benedict said I'm on Jumbotron, so I gotta make sure I put out. He's on Jumbotron. Jumbotron. Oops. Okay. And there's Nitish. Okay. So anyway, putting that back up there. Let's see. Forex Gal asks, is there economic news today? There is. We do have economic news today. We have some CPI out of Canada.
Yeah, we have Canadian data only.
Yeah, and frankly, I'm looking for a little bit weaker data. But what's that going to do to the dollar Canadian? I mean, well, first and foremost, when you talk about the dollar Canadian, I would not be a seller while we're above this 131.10 level, and that is the. Let me pull up a daily chart here. That is the multi-year big trend line, huge trend line here.
Nice look.
Yeah, it's comes in, and we spike down there, and again, if you use Forex Analytics, I sent out an update right when we're at 131.20, maybe 2. Said, basically warning, hey, we're below the 127% extension. You don't want to be short down here because there's a big multi-year trend line, and it popped back up. I don't know if I'd really want to be long at the moment. But I think while you're above this 131.20, I don't think you want to be short. Now, if we get below 131.20, that would be extremely bearish for the dollar CAD. So if for some reason inflation data comes in strong, we see CPI, like let's say the year over year comes in at 2% or 2.1% or some craziness, that dollar Canadian will break down. That would be my best guess. One of the other things, I'll talk about this, and then I'm gonna leave you guys. I see a lot of people, and when I say a lot, I'm talking a lot. It's already an over position trade right now. I see a lot of people long pesos. In a yield-starved world, they're just looking for yield somewhere. And right now, the best trade in the FX market for that is long pesos. Unfortunately, everybody's long pesos. And if you were using Forex Analytics, because I already sent out the chart like 2 hours ago, I warned that above 1897, you're going to start to see a squeeze. And frankly, we get back above 19, this is going to squeeze even further. This is one of those trades that could go absolutely earmuffs, kids, tits up for traders, is long peso trade. So, you see an unwind, just intraday, you can see this thing spike up, 100 pips pretty quick. All right. So anyway,
another carry trade that is in the precipice of breaking down, as the USD MXN did a few days ago. It's the USD ZAR. It's currently testing a triangle that dates back to August 2018.
Oh, well, you know what? I won't dive into that. I'll leave that for you to talk about. So I'll leave you something to talk about today.
Oh, don't worry. I have things to talk about.
But yeah, you always have things to cover. I know you do. All right. But I want to say, guys, if you are done with your Christmas or holiday shopping, maybe you bought all your Hanukkah gifts or all your Christmas gifts, make sure you reach out to Forest Park FX, our webinar sponsor. If you like the content that we provide you for free every day, this will help us out because they help, us make this possible. We've been working with them for years now, and they're really great at finding a broker that's best suited for you. And if you are in the United States and you don't qualify for the reimbursement program where you can join Forex Analytics, possibly for even free, outside the US, you can, opt in for a, cashback rebate program. So this is the reimbursement program. This is how you get a hold of them on Skype or directly from email. And you might even be able to stay with the broker you're at and still qualify for these programs, which is awesome. All right. So anyway, you guys have a great day. Good luck today. Thank you for being here. Happy Hump Day. And Steve Stelios, coach.
I always like that wish.
Yeah,
happy Hump Day.
Yeah, everybody likes a Hump Day. I like Hump Day too. You guys have a great day, and I will see you tomorrow morning.
Okay, Blake.
Thanks, guys.
By the way, here is the USD ZAR, Blake. This is the confluence of supports I'm talking about.
Oh wow!
So yeah, so quite an interesting juncture here. So let's see
what are rates in South Africa?
I think Stelios 6.5%, which for 2019, it's actually quite decent, right?
Yeah, absolutely. Yeah, good carry. Yeah. Okay, so we have some numbers in about 30 seconds.
Yeah, so let me switch. Speaking of which, let me switch then to the USD CAD.
Speaking of which, let me switch. You're a poet, man. It rhymes.
Oh yeah, it does.
So we have CAD CPI, and actually that's it. Then we have a New Zealand GDP, but that's in a few hours.
Let's see what we do here. So here's the channel we've been trapped in for quite some time. Let's see what we get. 10 seconds.
I mean, data recently in Canada has been coming out
Yeah.
weak, so you would
It's been
expect it
very
to be
weak.
slightly weaker, but it's a volatile
Yeah.
number, so it's a month-on-month number,
There we go.
-0.2.
Oh.
So yeah, it's actually there was
Yeah.
no forecast, right? On investment.com there is no forecast either, but
Yeah.
yeah.
Regardless, I mean, it's a negative print. The year-on-year,
Yeah.
though, is as expected at 1.9. And yeah, the year core and the year nominal are as expected. So
Yeah, it might
won't,
not be a big
yeah,
mover then.
won't move the needle. Yeah.
Okay. Okay, very little to talk about actually from yesterday. We have the it's the vote for Trump's impeachment today. So
Yeah,
let's
which
see what happens
irrelevant.
with that. Well, yeah, but obviously, markets like stocks especially can get a little bit jiggy.
It is historical, even though it's not a market event. There's
Yeah,
only,
I think nobody's going to care because there's no chance, in my opinion. I've said it since
he
the very
cares.
beginning, that the Senate.
He's a little upset about it, actually.
No, yeah, but no chance that
letter.
the Senate is going to vote.
Not
for,
everything
for removing
has
him.
to be a market event and for it to be important.
Yeah, true.
Don't you think?
Yeah, but
I mean, that's how we measure everything.
I really don't believe it's going to move the markets, though, because
I don't either.
I think the chances.
My point, though?
Yeah, I do. But
it's historical.
The chances for the Senate then to approve his removal are zero, literally zero.
Right.
Yeah. So yeah, he's not going to like it from a personal perspective. There's no question about it. But will it actually, create some type of an event that the markets will end up caring about? No, it's actually not. Yeah, I wish it was, because I would take anything that would create volatility. Anything really.
You're so mercenary.
And the markets, what do? They take news items and they discount whatever action they think is going to happen. And if no real action is going to happen, even if he gets impeached and all that, because like you said, the Senate will never, push it through. I think the markets are most likely to not do anything. But Dale correctly said, things can be important without moving the markets necessarily. Okay, so we had some data today.
See. Stell's my best friend now, Steve.
He is.
All I want for Christmas is you, Dale.
All right, man.
All right. So we had German IFO and business expectations and business climate. They all came in better than expected. The soft numbers still come in at pretty good levels. The problem is you have leading indicators which don't. But anyway, that's what we had from Germany. We had some important numbers from the UK as well. CPI came in at 1.5% year on year. It was expected to drop from 1.5 to 1.4. It didn't, but it's now it's been consistently below the 2% target for a few months. Remember, it used to be 3.5% not too long ago.
Yeah, because we had that steep depreciation, which affected inflation temporarily by a lot. Obviously.
Yes, absolutely. And we also had the CPI of the Eurozone at 1% as expected, way below the target. And if you remember from ECB's forecast, they don't really expect it to be climbing much over the next year or so. So still at quite subdued levels. And I personally find it extremely hard to see the ECB turning in any way hawkish with inflation that low. And also with German and Eurozone leading indicators being in deep contractionary levels. So that's what we had yesterday. Not really too much else to say. The pound is still doing its thing. There's been a lot of commentary about the pound being lower than before the elections, and we talked about it yesterday. It kind of makes sense because Boris Johnson brought back the no deal Brexit scenario on the table. He kind of had to in order to make his point.
In my opinion, it's just also profit taking from those that were in the right side of the market still. I mean, you know how it is. They bought the market's imbalanced valuation when the market was almost certainly pricing in like a no-deal Brexit. And that was a very good risk-reward trade back then. and then they sold the actual event. I mean, Boris
Yeah.
Johnson getting a comfortable majority.
Yes.
So I think it's also a technical move above everything else. I mean, at some point we would have to see like a healthy correction to this, big move higher, right?
Indeed, yes.
The
So
same deal with the euro pound. That's why I mentioned it yesterday. I mean, it was obvious to me that we would get some follow through to both of those. 130 is going to be an important first level to see if we're going to get a reaction. So I agree with Blake. It is a level that is worth, putting a toe in and seeing if you can get some rebound and making some pips there. Same deal with euro pound at the 86 cents area. I think we might see a reaction from there as well. Not that I would find it unlikely to see even a deeper correction lower, but I do think that in the grand scheme of things, seeing a healthy correction either in time or in price or or a combination of the two is probably going to produce another decent um, opportunity to trade the pound the long way. But admittedly, the easy money have already been made, right? The easy part of the move. When the market was, so imbalanced, that imbalance is at some extent out of the way now. So I think it's unlikely to see like, very, very steep moves from this point on forward unless we get some, some political events that are unexpected or,
Boris Johnson will be impeached.
Yeah, that is almost, that is almost a zero probability. I mean, he just had one of the most comfortable, wins in UK's recent history. So I think that nobody's moving him from his position.
Yep.
Even those that don't like him, with the majority that he got, it would be almost impossible for them to doubt him openly. You know what I mean?
Yeah.
Yeah. Okay, that's it from me, Steve. So you can take it away.
You're going to ballet, bro?
Ballet? No.
Your daughter's not taking ballet lessons?
Not this year. No, they're doing everything at school this year, so I don't have to run them around like a madman.
Like an Uber dad.
Uber dad, yeah, exactly.
Uber dad, yeah.
All right, buddy. Well, have a great one. I'll hang out with
guys.
Steve.
I'll be here.
Okay, great. So Jason is asking, Steve, in your view, has the perfect recipe of stock buybacks and central bank liquidity positioned this market for S&P 4,000? Is there anything that can change this going forward? Fundamentals no longer seem to matter until they do. As I've talked about in the past, fundamentals are, like gravity. I mean, even if you're Michael Jordan, you might seem to be ignoring it, for a little bit of time. And in the grand scheme of things, a few years can be a little bit of time. I mean, historically speaking, but gravity gets hold of everything. So, is it impossible to see S&P 4,000? No, but it's very, very unlikely, in my opinion. We know, even if you want to take it from a cycle perspective, we know that cyclically, there's a thing called the presidential cycle. So we know that usually the first year of a presidential cycle historically has been the weakest. Now, combine that with the fact that if we actually do make it to the next election without having, gotten already disintegrated by, a combination of events, because the market is hanging on artificial support, as you very well mentioned. So if we assume that they manage to push it for another year, so we go through the elections, even historically speaking, as I said, the first year of the new cycle is always the weakest. So combine that with the fact that we're going to be in the 12th year of this business cycle's recovery, which is going to be more than 2 years longer than anything else we've had in the past. And with the fact that, from a debt perspective, from like deficit perspectives and everything else, things are really, really grim. So no, I don't think that there is any real chance that we can keep on grinding higher more than within 2020. So what are the odds that we're actually going to manage to move to 4,000 by then? Very little. I mean, this year somebody can argue that we've had a 27% rally higher, but that is one reason we got that is because we got that deep correction lower, a little bit more than 20%, and we climbed out of that, right? So don't expect, I mean, we're most likely going to close the year at all-time highs or very close to all-time highs. So don't expect another 25% higher from all-time highs, with everything that's happening. So don't expect another 25% next year. I think it's going to be extremely hard for that to happen. So also something that has been working beautifully for me I have this on my charts for, I don't really remember it. It must have been like 4 or 5 years, this pitchfork that you see here. Every time in this pitchfork that we exceed this 100%, because this is the 200% trend line. Okay, every time we exceed the 100% trend line, with the biggest example being that mania phase we went through and peaked at January of 2018, that we actually managed briefly to go through the 200% as well, and then you see what happened. We came down to the median line. And every time we've exceeded it, to be fair, on the downside as well, we've had a big reaction to the other side. And look where we currently are. We've exceeded the 100% line, and we're more than halfway to the 200%. So, even if you want to look at it as from a mean reversion perspective, I think that we're getting very, very close to at least some kind of a reset of this bull market. So even if we're talking about like a correction, we might, get back to that 200% line, and then, revert back to the mean somewhat, like, come back there, or even deeper, before we can be looking or talking for, higher levels. So that's what I think about the S&P. I think that, buying it up here, with all the history this pitchfork has had, and with the market having already priced in rainbows, unicorns, and mermaids, and whatever else you want to think about, I think it's a bad risk reward opportunity. Happens all the time. Buy the rumors, sell the news. Yes, it does. I'm surprised that you didn't expect it, guys. It definitely wasn't unexpected. I mean, I expected that we might have, my expectation was that we might have made it to the 136 level. We made it to 135.20. Close, but no cigar. But, as I said, this is a healthy correction. I mean, nothing really to talk about here. USD CAD, by the way, is actually weakening. So the Canadian is strengthening. Yeah, which is kind of weird. We've had, very bad data out of Canada. I mean, with that unemployment data last week being like, horrible. And still the USD CAD can't really hold a bid for the last few days. Of course, as I've mentioned multiple times, there is nothing to do here between 133.50 and 130.50, right? So, I mean, there's still no event to talk about. But, in my opinion, below 130.50, we're going to see more weakness. Above 133.50, we're going to see a squeeze higher. So, anything in between, in my opinion, is, simply noise. So, of course, if you're a scalper, you might be looking all that from a totally different perspective, but it is what it is. Now, Blake didn't mention the USD yen, so that was another one I wanted to mention. Keep in mind that the USD yen is still flirting. I mean, we've done that so many times, right? With this inverted head and shoulders formation neckline, also horizontal resistance area. So keep a close eye to this. I mean, we've failed to penetrate through so many times, but on the other hand, we've failed to really break down so many times after failing to, break higher. So something has to give here, and this is probably going to follow yields, right? Because as you've seen, I mean, we've had so much risk on, and that hasn't been enough for the USD yen to actually make a decent move. So it's all about what the yields are going to be doing. It's going to follow them much closer than it does with risk. So, we're currently at resistance. So do what you wish with it. I mean, you want to be short, this is an excellent place to be short because you can risk very little. But, if we breach through that, I think this market can squeeze 150 pips easily to the upside. So, this is one to notice. And another one to notice is Palladium. I talked about it the other day. Palladium is now attempting to break through this ascending channel. So I think, it's about time to see some kind of a decent correction from Palladium, and it might be starting from here. I think with the move higher we've seen, a pullback to 1825 is something that can happen within a few days. Just consider that yesterday at the highs of the day, we actually managed to achieve the 2000, to make it above 2000, which I think it's the first metal that ever does that. And today at the lows of the day, we were like $85 lower than yesterday's high. So, this might prove to be one of those cases that we talk about, up with the escalator, down with the elevator. So, yeah, I mean, since breaking through this cup and handle formation, it's been, with the exception of this little pullback here, it's been like a one-way street, and grinding higher nonstop. But keep in mind that when you see moves like that, you can then easily see a very decent retracement happening within like 5 days. So from a risk reward perspective, I think it looks very decent to attempt to be short here, for a pullback. Of course, I want to see the daily close as always, because intraday, that could be noise. I mean, we came down to 1915 and we are already $20 higher. So let's see how we close the day. Now, crude is also in the situation that Palladium was. I mean, it keeps grinding higher, of course, not in a bull trend as Palladium, but it keeps grinding higher. But grinding higher, and still can't, push through this channel and this triangle in general. You can see that this triangle's resistance is like a few dollars above this channel. And, if we keep on going slowly in a few days, those are also going to confluence exactly with the 78.6 that we're currently at. So, let's see what happens here. I still favor the downside. I think from a risk reward perspective, it's an excellent trade. And, despite all this recovery, there's no momentum here. So I still think that from a risk reward perspective, this is a very decent short. And if it works, going down like $3 to 57.50, 57.70 can happen very fast and very easily. It can happen within a couple of days, right? So, I mean, you're looking to make $2.8 of downside, and you would be risking something like $1 of upside, roughly. So that doesn't look bad. It looks very decent in my opinion. It's a decent risk reward. What else? What else is worth mentioning here? Let me go through your questions. Yeah, I remember most of those on Twitter were
Steve,
long.
do you think what happened in the USD won last week, and I'm looking at it right now, we had, a false breakdown, it looked like, on the
and
trade
then a
view.
rebound, an immediate rebound, right?
Yeah, and since then, it really hasn't given up much if you look
Here it
at it
is.
like a 4-hour.
Yeah, here it is.
Yeah,
it doesn't look really bearish. I mean,
No, yeah.
Initially I was looking at this as, but perhaps not. Perhaps more likely than not, this is one
Yeah,
move
that's
here.
what I think we have. And that's
Yeah.
what Gregor showed yesterday too. He's looking for one more new high. I think that will trigger some risk off.
It seems very, very likely. It seems
That's
very,
what
very
I'm
likely.
looking at for, so what that's telling me is the market celebrated a deal that we don't really even know all the details yet, or whether there'll be any hiccups with what was agreed to, if it could be implemented. So,
Oh, speaking
me,
of which, let me. Unfortunately, this is not an iMac. So give me a second to copy. Go ahead. Give me a second to just copy on Dropbox something that I took a screenshot
Okay.
of today, which is exactly about what you're talking about the deal, and it's quite interesting. So let me move it from my iPad.
What a great live broadcast, huh, everyone?
Yeah, to Dropbox. There it is. Saving it.
And David Keller is in the house, so anytime you want to wrap it up, we can.
Yeah, we have some time, so we're gonna cover questions.
You ever
So
go to
let's
that
see.
site, stockcharts.com?
No, I don't think so.
God, I've been using it for many years. They've really upgraded the content. They have a TV
So
program.
there you go, coach.
All
Since
right.
you mentioned it.
Okay.
So, two versions of a deal. What the
Yeah.
US says and what China says about, each of the parts.
Yeah. Pretty
As you'll see, there are, especially in some key issues, some very obvious divergences, right?
Yeah.
I mean, just
there's
look
a
at
key word: hope to sign an agreement.
yeah,
Now,
yeah.
you know what?
Yeah.
Hope is the oxygen in our life, Steve, but it's the carbon monoxide in trading and negotiating.
Not only that.
Hope.
This is one important part, which is the signing,
Yeah.
which they hope to sign, blah blah blah.
Right.
China hasn't mentioned anything about timing, but there is something else that is also missing from this. I took that screenshot because it's good, but there is also one element missing, which they should have put up here, which is important. The US is claiming that once they sign phase one deal, which as you see from here, they hope that it's going to be within January and then take effect within 30 days. They said that negotiations about phase two are going to begin immediately. Now, China, on the other hand, has said that once phase one has been agreed and signed, they would want to wait for some time to see that what has been agreed upon on phase one is being implemented before they're willing to go into negotiations of phase two.
That's a lot of time.
Exactly. So as you understand, what the current administration wants to do is to repeat the US-Chinese saga of 2019 in 2020, delivering this underwhelming phase one deal, and then immediately start pushing headlines to the market like phase two negotiations are doing well and we're getting close, and hoping that the market is going to keep buying the same type of rumor it was buying for initially the deal. Because I remind you that until very recently, Trump was claiming that there's going to be one deal, comprehensive, including everything and you name it. And then when that wasn't possible, then very lately we got the version of, okay, we're going to make it a phase one and phase two. And who knows if they find it hard to deliver phase two, which in my opinion they will, because the Chinese are not stupid. They know that politically he can benefit a lot from having a phase two. I wouldn't be surprised if
They would rather work with Biden if that's a possibility.
No, I wouldn't be surprised if the Trump administration then starts pushing for a phase two that's going to be also underwhelming, and promising that after that phase two, there is actually going to be a phase three. You know what I mean? Whatever it takes to keep the rumor mill spinning, again and again. And
it reminds me of Star Trek phasers. So we have phasers going on. But anyway, you know, that keyword hope,
Yeah.
and they're still negotiating. We don't even know if we have this one.
No, we don't.
Okay, that's
No,
my
we
point.
don't.
And the yuan is, I think, giving us a message that some doubts are going to creep in about what the market has already accepted as a reality.
Yeah, and
That's what I think.
that can be a great catalyst for a pullback, right?
Yeah, right.
Because the market has
725
yeah
yuan,
the market
730.
no, I was talking now about a stock pullback. So if, for
Yeah,
example, at some point
the
during
yuan, I think, will trigger it.
oh yeah, I mean those are
That's
going
what
to
I'm
move in
saying.
those are going to move in tandem. I mean,
Yeah.
if now that the market has fully priced in a phase one deal, we get in January and we start getting some rumors from the Chinese because they will want to push for more concessions, because don't forget that the phase one deal, even from what you saw from that screenshot that I just put on, is not 100% solid either. I mean, it has a lot of like vagueness in it still to be determined, right?
Yeah, I would
So,
say that it it would be a pretty weak prenuptial agreement.
oh yeah. In essence, what it is a ceasefire, a temporary ceasefire, with the hope and expectation that that can lead to a deal. Because let's be honest, phase one is not a deal. It's, as I said, it's more or less a ceasefire and an agreement to work for a deal. That's what it is.
Yeah, theater.
Yeah,
So,
more or less political theater. Yes.
So any other questions you want to cover here?
Yeah, there's a question about the Aussie. So there's nothing I have to add or remove to what I've said the previous few days. The failure from 69.30 is important, as the failure from 111.80 was important for the Euro USD. We're back within this channel, so I'm gonna get very bullish the Aussie if we see a daily close above 69.30. Until that happens, the path of least resistance remains lower. Okay, as simple as that. Economic news today, now we covered that. USD SEC, yeah, as you remember, we've talked about that again and again, and Blake did cover it. Is the head and shoulder a natural phenomena or an artificial one? No. It is a formation that has been observed in the markets from decades ago.
The caveman
Yeah, I mean,
used to
no,
chart with rocks. Yeah.
yeah, it is a formation that has validity. It is a formation that has validity.
It's also a very good shampoo if you have a problem.
Do we actually get actually something for promoting them, or?
Yeah, like Troy Palomano. So yeah, okay, bro.
So one last thing, and then you can start about gold and silver. I don't share the, they're dumping lower or whatever. None of that is happening. Both gold and silver have found resistance where you would expect them to find resistance. Look at this; it's perfect, right?
Yeah.
And as long as that's the case, as I've said multiple times, we can even see a lower low.
Yeah.
But I do believe that in both cases, those formations are going to prove to be corrective. And I do expect that we're going to squeeze higher once again.
Nice
So,
wedge.
yeah. So I don't know if it's going to be imminent or if it's going to come from lower levels, which, I'm going to be buying gold at 14. If we get down to 1433, the 61.8, I'm going to be buying gold, no questions asked. I'm also going to be buying gold when we break out from 1485. I can tell you that in advance. So, I have two plans: either buying the breakout if we don't make it lower, or I'm going to start buying if we actually make it to the 61.8. I'm going to start buying there and get a better entry level. So, whichever of the two comes first. But I do think that eventually, and not far away in time. I mean, within the next few months, worst case scenario, they're headed much higher than where we are. Okay, coach. Thanks.
All right,
Enjoy the
thank you.
interview.
All right. Thank you, Steve. Let me just look for David's right here. Whoop. Okay. Okay, David. You're unmuted now, David.
Good morning. How are you?
David, it's a pleasure to meet you. Thank you so much for coming in today.
Of course.
I've been talking about your service and how Stock Charts has really upped their game in the last couple of years. You know, you have some of the legendary guys that provide content for you, and you know, you have television broadcasts that you do. So you're good on both sides of the mic, huh? You could go you could go either way on a mic.
I'll do what I can. Yeah.
We're bi-microphonals anyway. So there is a share screen option here, David. It's a little green box if you want to show your setup or website, and there it goes. Okay, beautiful. All right, so David, you know, it's the first time I've met you.
Yeah.
And I know you've been in the industry for a long time. Can you tell us just a little bit about your journey into it and how it began for you?
Absolutely. And not surprisingly, as a professional technical analyst, I have a chart to answer the question.
Okay.
I've been in the
look at
industry
that.
since
right.
mid 2000, June of 2000. And to
Okay.
walk you quickly for your viewers that aren't familiar with my work, I started at Bloomberg in New York. I was there from 2000 to 2008. And that's when I learned technical analysis. I had actually studied music and psychology as an undergrad at Ohio State, which is a non-traditional training for the financial industry. But if you think about it, it actually turned out to be remarkably good for technical analysis because one, it's a study of psychology, a study of sentiment. And when I learned there was a technique that helped you get inside other investors' heads, I was totally hooked. And then, you know, the first time I learned about Fibonacci numbers was in music, because the whole musical scale, the octave, all of that is based off of Fibonacci patterns and Fibonacci relationships. So when I learned that you could apply that in investing as well, same thing. It sort of made sense to me.
Yeah. So I you know, the road that you took was really preparing you for this. And you know, I've talked to a lot of musicians that, you know, love trading because of that. You know, everything is math, isn't it? Whoever created this universe, there's some type of natural order. And today someone was asking, is, you know, Head and Shoulders pattern a natural phenomena? And yeah, patterns that repeat definitely give us some insights into how to approach a market, define our risk, look for targets. So what's the second destination there, that green?
Yeah, so after being at
Fidelity?
Bloomberg, yeah, that was Fidelity. So I was Bloomberg until 2008, and I ran the technical, you know, team of product specialists that would travel around North and South America. And then I was hired by Fidelity in 2008 to run their technical research department up in Boston. So I was part of the asset management division. We ran all the equity mutual funds, and I ran a team of altogether about 20 analysts that would give buy and sell recommendations to the equity portfolio managers based purely on technical inputs.
What was it like at Fidelity in March of 2009?
There's a lot of red on a lot of monitors. I will tell you that those first, and it really started earlier when the first big sell-offs in 2008. I remember a couple of my analysts and I just standing in my office looking at our monitors and just watching things accelerate, and just no one was saying anything. We're just kind of staring at these things going down, 10% at a clip, which was outrageously unique. It was fascinating. But I tell you what, I grew a lot as an investor during that 2009 to 2011 period. That was a fantastic experience, and I'm glad it's behind me now.
Do you agree, David, that we learn the most from our mistakes?
I would say every really good investor I've ever met has a story of climactic loss from earlier in their career. It's a formative experience where they learn how to deal with adversity. And, you know, for me, I mean, 9/11 living in New York was probably my first big experience with that, and just the whole cyclical bear market. But that period in 2008 to 2010 was
Bobby Axelrod was shorting transports and airlines that day.
That's right.
Right? Okay.
Yeah.
I know. That must have been. Were you in New York when it happened?
Yeah, so we actually lived in Princeton, New Jersey. So my wife
Oh,
was in the city. I was actually working out of our Princeton office. So,
yeah,
but yeah, lost colleagues and a lot of clients. It was
yeah,
not fun.
yeah. Okay, so after Fidelity, um,
Yeah, so this is the
what's
CMT
that?
Association, which was called the
Oh,
MTA. So that's the Professional Organization for Technical Analysis. And I was
right.
president of the organization from 2010 to 2014, which was a really, really cool experience. And it was dealing with a lot of volunteers from the global organizations, about 5,000 members now around the world. But I tell you what, that's where I grew an appreciation for um, the US industry and the US financial markets versus all the other places that people are investing. So spent a lot of time talking with members in India and Europe and developing Asia and Latin America. And, it was really helpful to sort of think about how all these markets are interrelated.
And plus all the people you got to know. I'm a big believer in intelligence gathering, David.
Yeah.
I always do my own thing, but there are people whose work I respect. We have kind of a team. We not kind of, we have a team concept here, and people use different disciplines, Elliott harmonics. I use some J.R. Hill stuff. So um it really helps, since we only have two eyes, to be collaborating with people that can see things that might point your eye towards something you didn't see on your own.
That's right. That's right. And I think, and again, I've always told people it's great to learn lessons from others, and especially, I mean, the best thing you can do is invest, is try something and see how it goes. And you will lose money, and you will learn a great deal from that. But it's great to get help from others, especially when there aren't a lot of zeros attached to your account yet, because that's when you can really start to, you know, get some good routines under your feet, get some good sense of how others have tried to win this game, and then try to emulate that as much as you can.
Okay, so now we move on to the airplane.
There we go. So I launched my own research firm. I left Fidelity end of 2016. I launched my own sort of research and consulting firm called Sierra Alpha Research end of 2017. And that's that icon there. So I spent most of my time with that, working with institutional investors, but also a lot of financial advisors, and working with them to address behavioral challenges in their investment process. So we talk a lot about how they make decisions and all the behavioral baggage that can get in
It's
the way of good
it's
decision
all in
making.
our heads.
It really is. So getting out of our own way, having an honest conversation
Yes.
with ourselves ends up being really, really key, I think,
Yeah.
to trading, to investing. And so that I've enjoyed working, one-on-one coaching a lot of advisors, talking through some of those challenges for
I
sure.
love that. Do you advise people to journal?
100%. And I do two things. The one is a morning journal. So every morning, 3 pages that you fill with whatever is in your head. And I would encourage your viewers that are trading and have a beginning to the day. Start with getting all of the crap out of your head. Write it down and just get it out of there. And you will find you have a much clearer perspective with what you're trying to accomplish. You'll be much more focused. And then
Like
also having a good
Like
trading journal is
NLP,
key.
neuro linguistic programming. If you
That's
write
right.
something down, it has more impact on you.
Makes a huge difference, right? And just
Yeah.
thinking about it is a start, but really writing it down physically, it connects to your brain in a meaningful way, and it starts to be more real. That's right.
I used to update my charts by hand in the old days.
You know, I met with Ralph Acampora outside of
Okay.
Minneapolis a couple months ago. We talked a
Yeah.
lot about he was lamenting that most technical analysts, me included, did not learn to chart by hand. I think I'm just 43, and I was learning all
Don't rub it in,
electronically.
David. Go ahead, buddy.
But I think I think we missed something by not charting things by hand. And Bruce Kamick, who taught technical analysis at Baruch College in New York for years and years, swore by he would make all the students draw out charts by hand. And I totally agree. I think that I later, when I was learning point and figure charting, kept a
Yeah.
point and figure book for a couple of years, and that
Right.
I internalized it so much more because of that.
Yeah, that was. I mean, a lot of guys on the floor had clerks that would do the X's and O's for them
Sure,
while they were trading.
sure.
So here we are today.
And then here we
Stock
are.
chart.
Yeah. So I joined stockcharts.com about 3 months ago. That involved a relocation to the Seattle area. So I'm in the Pacific
Nice.
Northwest now, which has been great. We really enjoyed it. And yeah, Stock Charts is a really cool place. It's been around for about 20 years, and was started by Chip Anderson, who was a former Microsoft engineer and literally bought the domain and started building a charting program from scratch. And we've sort of grown it from there. So I joined as chief market strategist, and our goal, as you kind of alluded to, and thanks for the introduction, kind of thinking about all the different ways we can add value for technically oriented traders and investors. And we think about it in terms of the tools you have, the education to understand the product or understand the tools better, and then commentary, learning from those that have come before us, guys like John Murphy and Martin Pring and others.
Yeah, exactly. I know those are names that take me back to, well, not my beginning, but maybe middle. Anyway, David, so interesting journey, and with what's happening here, maybe we could talk a little bit. It looks like you prepared a PowerPoint for us. Is that it, or you want
all sorts of things
ad lib?
for you?
I'm kind of interested, and we're looking at the end of the year.
Yep.
And that worst December last year since 1929, and the market has been a wonderful place to be for the full year.
Sure.
Looking ahead into 2020, you're looking for a continuation of this bull market. Could we have a 10% correction if perhaps like this trade deal that everyone's celebrating, as you can see, like they're hoping to sign a deal while the Chinese say they're still negotiating the deal.
Right.
What's your view going into 2020?
So I
in
was
the
listening
stretch market? Go ahead.
I was listening to Steve's comments before, which overall I thought were very, very interesting, and especially in terms of the U.S.-China deal and how to make sense of it. I would start by saying hope is never a good investment strategy. So
Yeah.
let's stay grounded in what we're seeing in the trends and the price, and price is the most important thing to pay attention to. I would firmly say to everyone, because that's what tells you how people are interpreting what's going on. Last week, I spent the week in New York and had a morning on the floor of the New York Stock Exchange with one of the floor governors. We had a great morning kind of talking about his role. And it was that morning, and it was Thursday morning when the Trump tweet came out first thing saying, China deal's done, it's happening soon.
Can I ask you one question? Who does he govern? The floor is a bowling alley.
Yeah.
Right, every floor.
He governs the shrinking number of gainfully employed market.
He's got the easiest job in the city.
So it's funny. I was very.
He manages a CNBC crew.
No, I was wondering exactly what it was. What was interesting is actually there's an IPO going on for Build.com that morning, and what I did not realize was how much the market makers are intimately involved in the IPO process. That is still a very human-driven, manual. Process dealing with supply and demand real time and setting the opening price, figuring out how it's going to come out. That there's a point where I think they still have a very valuable role. A lot of what would have been manual years ago, as you know, is all electronic, it's all automated now.
Yeah, well, we might miss those bodies in a time if market structure and the machines are running things. We might miss having a backstop of a market maker. What do you think?
It's funny. I'm asked a lot because I talk a lot about behavioral finance and investing, and I get a lot of questions about man versus machine and how things are automated. And I think you're right. I would say two things about that. Number one, there's always these unintended consequences when things are over automated, and having, what he basically does is things are going, but he has a set of alerts. And when something would happen that's sort of outside of a normal acceptable range, then he jumps in to address it. So he's still, watching and waiting to come in. And there are times when he has to step in. And in particular, at the open and at the close is when he still is involved every day, because there's a lot of order imbalances and things like that. And he has to set the prices. So I think there is still certainly a role for humans there. And then the second thing is when, if and when the market meaningfully corrects, which is going to happen at some point, you're not going to want your computer to tell you the market's correcting, you just lost X amount of dollars, no problem. You want to sit down with a person and have a conversation with someone who can put themselves in your shoes. And so I think the roles in the financial industry are going to have to evolve. That makes sense. But there are still going to be places where humans are very, very necessary. And I think, people that want to be successful in the industry going forward, I would be gravitating towards those types of roles that are going to keep adding value.
Okay. And don't you think that the experiences of 2000 and 2008, where people were just balanced a certain percentage in bonds, equities, cash, whatever, and they felt like they were okay, and they lived through huge drawdowns. They finally said to themselves, as they look at their salesmen at a number of wirehouses, is that if anyone's going to lose my money from now on, it's going to be me. And that's why the big boom towards self-directed trading and trading education happened.
That's exactly right. Yeah, there's an empowerment that comes with investing, and especially with technical analysis. If you think about it, I mean, technical analysis was created, I mean, centuries ago, if you go back to candlesticks analysis. But in terms of modern technical analysis, about 100 years ago plus, Charles Dow and the ideas of trends and all that. And it was
had lunch with the guy.
I'm sure you grew up together. I wasn't going to ask that. Yeah, right. But I mean, remember that this was before fundamental analysis was a thing, right? Companies didn't really have to report anything meaningfully in the early 1900s. Technical analysis actually predates it. And it was, I think, designed as a way for self-directed investors to have any sort of advantage in the market and compete against the robber barons who were sort of driving the financial industry. And as the markets have evolved and fundamental analysis has come on and all sorts of, computer power and everything, things have sort of fluctuated. But at the end of the day, the ability of an individual investor and a self-directed trader to use price action to understand what's happening and have an advantage over others is, I would say, resonates now more than ever. So I think it's a really, I think the ability of charts to add value has not waned in one bit. What concerns me, though, asking about the market going into next year, this is looking at the S&P 500 now, going back to sort of the end of 2009. And what concerns me, you asked about sort of a market outlook. I mean, I think overall we're holding up just fine. And as long as the trend continues of higher highs and higher lows, the trend is undeniably positive. That is fact. That's not opinion. So I'm happy to remain, constructive on the markets until that picture changes. But what concerns me is that any investor that started investing in the last 10 years, which is a growing cohort of investors that now are starting to manage some real money because they're in their 30s, this is all they've known, is a chart that goes from the lower left to the upper right, and it just keeps continuing higher. And it's similar to the fact that bonds in a secular bull market for 30 plus years, no one knew any different. No one really saw what happens when interest rates start going up, or what happens when bonds aren't a savings account. They actually can lose value sometimes. And so what concerns me is if and when we do have a meaningful rollover in stocks, which I think will come for sure at some point, I think a lot of people will be unprepared for what that actually feels like, because we've forgotten some of those lessons from 15 years ago. It's just been too long.
Where do you stand on the historical levels we're at on, say, the stock versus commodity ratio? Because some commodity markets are starting to percolate a little bit. Precious metals had a good year.
Yeah, so this is a view that and what I'm showing you here, just so you know, I sort of, this time of morning is when I usually get up and do what I call the morning coffee routine. And I start with a weekly chart of the S&P 500, and I just go down through every set of charts that are really interesting to me. And I get a sense of where things are at. Then I go into the office and sort of get ready to go with the day. And so this is the point where I would hit intermarket analysis, which is what you sort of alluded to, and thinking about, at this point, I've sort of internalized what I see with stocks and stocks overall, just in a secular bull market, in a cyclical bull market, tactically looking overextended, I would argue. And the fact that the S&P is overbought here again suggests a little bit. I don't feel like,
David, I knew some wave guys, and I used to do this on FX Street, and I'm talking about years ago.
Yeah,
that threw out, and we were a lot lower then. Had a 3,200 target that is currently manifesting in here.
That's right.
And I'm not an Elliotician, but it's stuck in my head, 3,200, and here we are. So I was just wondering if there was anything significant that you see at these levels with your discipline.
Yeah, so not necessarily. And I would say I thought a lot more about wave patterns in my Bloomberg days when I was working with hedge funds, because they would be focused a lot more on price levels and anticipating inflection points. My time at Fidelity probably skewed me much more toward trend following, because if you're a money manager and the market hits 3,200, that doesn't mean a ton if the stocks are still going up. You have to own them. Just for client's sake, I mean, you have to be where things are working. And so you're much better off following trends and anticipating trends, but really making sure you're there. So at this point, I mean, it's more of a long and strong environment. And I feel like the market's sort of innocent until proven guilty. Until you get some sort of indication that things are reversing, you still have to assume that there's strength in stocks. I think
Okay.
For me though, it's less the level, but I think how the price is actually going to evolve over the next couple months. We're in that seasonally strongest part of the year, sort of November to April. Stocks tend to do well, but I would say when you look at history, those are median level, right? That's the median return tends to be positive, and then the average return tends to be positive as well.
So,
but that doesn't mean that it could be up just a little bit. It doesn't have to be up 20% over that 6-month period. So I think there could be a scenario here where stocks just don't go down meaningfully, but they don't go up meaningfully. And it's sort of that vicious third direction, which is more of a choppy digestion of all of these gains.
Yeah.
Steve was mentioning earlier just about the trade deal and what's actually priced in. I think that's what hit me when I was on the floor last Thursday and that tweet came out and the guy next to me said, well, that's it. It's priced in now. That he said it's done. It is now priced in. So what else is going to drive things higher from here? And I think there might be something there. At some point, there's either a manifestation of some of these rumors that we've been told, or there's frustration, and it feels more like we're going to have the latter instead of the former. I think that's when you get some pullbacks of substance here.
Okay, well, I see you have RSI on your charts, and I've renamed it to the real simple implicator. Implicator is not a word, but it implies things to me. That's the point of it. And you use RSI, and I'm wondering if this divergence that we're seeing here on what's this, a daily chart,
Yes.
means anything to you. It's almost we had two equal, but 71 is not such a great reading. We're not confirming, and to me that's at least lighten up on long signal. I'm wondering if you have it up there, if you use it.
I totally agree. And it is, if there's one indicator that I would use beyond just price and moving averages, kind of overlay type of stuff, RSI would be it. So I think it's a great way of standardizing price movements and understanding what the thing usually does and what it's doing right now. And are those in agreement or not? And what you're seeing here with not just the S&P 500, but with Apple, with Disney, with the XLV, the healthcare sector, they're
A lot
all
of
having
non-confirmations, huh?
all non-confirmations. So you have this,
Okay.
the higher highs in price, the lower peak in RSI. And, I would say technically it's probably confirmed if we come out of this overbought region. And when we do, all of a sudden it feels very similar to July. We had a very similar pattern of higher highs, a lower peak. Now, again, the primary trend remained positive. Overall, we continued, but this is a move I think people are probably not, excited to feel. And it's going to be, because we've been in such a strong market, it feels a lot worse than it really will be. And I think a lot of people need to be sort of ready with how to deal with that potential downside.
Okay. Could I ask you what your views are on what's been happening in the overnight Fed funds market and repo market? At first we were told it was just corporate tax pressures. The Fed has really had to pump a lot of money in there. There's people talking about another squeeze towards year end of
Yeah.
rolling over paper. Do you think this is technical, or could it be a canary?
Well, so that, and again, what concerns me, and I think what should concern many, is it's a huge unknown. And I bucket what you just described along with the impact of dark pools and high frequency trading as phenomena that we know are happening, but in terms of how much they're really impacting things day to day is an unknown. And an unknown for me doesn't feel bullish. An unknown, that uncertainty feels more bearish than bullish to me. So I mean, there's no doubt there's QE that's happening. There's artificial ways that markets are being held up. I think that is probably pretty safe to agree on. But the extent to which that is happening and the extent to which that would prevent a meaningful decline is what's really unknown. And again, we won't really know until it happens. But what I will say is, regardless of what you just described, I think the fear that will be palpable when markets do start to correct a little bit, and when things start to break down, and a portfolio that has continued to grow meaningfully starts to shrink meaningfully, fear all of a sudden manifests very, very quickly, and it feeds back on itself. And I think that could overwhelm any of the artificial support that we might have seen on the market so far. I could be totally wrong, but for me, I've and maybe it's because I started in 2000, and so the beginning of my career was dealing with a raging bull market that completely unwound.
Post-traumatic stress.
It may be. I don't know if I'll ever get over it, but I know when the market gets new highs, I get very skeptical, and that served me very well in 2007 when I said, this is a top, this is happening, and I was very well equipped for it. It did not serve me well in 2013 when I said this is a top, and it completely blew through it and went higher. But I'm seeing conditions now that are similar to that euphoria that we've seen, and it's in so many ways. It's also, the IPO, the whole, the WeWork phenomena, all of these things that have happened that feel very late 90s to me. And I think you could draw a lot of parallels between where we're at and sort of like the 98, 99 period. So the challenge, I think, for a lot of maybe your viewers, if they're more short-term oriented, I always think there are a lot of career busting moves that can happen between this moment and when a meaningful correction could happen. So I think you have to stay diligent and you have to be following price action and see what's actually happening day to day, week to week. But overall, that's what I feel. I feel like we've extended to the point, and with the divergences you're saying, it doesn't feel like the time when new money necessarily makes a ton of sense in equities. I feel like holding positions that you have, I could totally see that because the trend remains positive. But for me, I'm looking for ways to diversify away from that. You mentioned commodities, and again, I think I'm always looking for themes that people are unprepared for, or unexperienced with, and a situation where things like gold and oil start to do very, very well in a way that outpaces equities even would be an unusual environment that people are not really ready for.
Yeah, or sugar, or almost any commodity markets.
Absolutely.
So does currency, the value of the dollar, do you pay attention to it? Does it play into your analysis of how you look at the world? Strong dollar, weak dollar?
Absolutely. And for me, when I'm thinking of the dollar chart, it's a couple things. Number one is the relationship of the dollar to stocks. I mean, obviously, our company's stock charts, and we focus on equities. But in the course of being a good equity investor, I would argue you need to be aware of all these different assets and how they relate to your equity positions. So for me, the dollar has two key takeaways. One is just the impact on the overall equity markets, maybe three. The second would be sort of small cap versus large cap and what you might expect there. And then the third one, which I think might be really important here, is the relative performance of non-US stocks versus US stocks. So, what we've seen with the dollar, looking at the last year and a half or so, is we've had this corrective pattern. We had it at the end of December, sort of this meaningful pullback, and then a resolution higher. We had the same thing over the summer, a breakdown of the 200-day, but it reverses right back. We had some of this similar pattern at the time. I wrote a note to customers saying, this is a very similar look, but if this doesn't play out the same way, I think that's going to be a very different environment that we need to be ready for. And what happened is we sort of failed. We had a lower high for the first time after that pattern. And now we've broken down through the 200-day. I'd argue this is sort of a dead cat bounce of sorts. And I think we might have further downside. What tends to happen in that environment is non-US stocks tend to outperform US stocks on a relative basis. And that has not been the case for a number of years now. And so there are ways, obviously, to look at that. One of the ratios I would look at is US versus non-US stocks. I'll quickly go through, whoops, my ratio there. You can see how that looks. Growth value, emerging markets, US versus the world. So this is the US SPY versus ACWI, All Country World Index. So US stocks have been outperforming consistently. We've not really outperformed meaningfully in the last 4 or 5 months. It's sort of been sideways. And we potentially have sort of this double topping pattern, and we're just starting to see a turn down. If the dollar continues to weaken, you would assume that would continue to go lower. And I think a lot of equity investors in particular have sort of written off non-US stocks because they just haven't got paid to own them for a long time. But if they start
they want to own the best dirty shirts. That's been programmed into them, right? I just have one more area, and then we'll wrap it. You have a view on yields?
Yeah, absolutely. So going back to this, I think